Satya Skills. In this video, let us learn basics of ratio analysis. Ratio analysis emerged as an important technique to analyze and understand the financial health of a firm and also to check the performance and condition of financial state of a firm. Let us look into its meaning. Financial ratio is an index of two related items or two groups of items in the financial data of a firm, which is obtained by dividing one quantity by the other. It's a simple definition. A ratio is relationship expressed in mathematical terms between two related figures. A ratio is defined as a quotient of two quantitative expressions. For an elaborate definition, we can opt for the next one. Thus, ratio analysis is one of the common tools applied by the financial analyst to interpret the data and draw conclusions, make decisions. Now, let us look into the concept of why to use ratio analysis. Is there any use of it, any advantage of it? Let us see. Ratio analysis is a simple but powerful tool to check up the financial health of a particular organization, either for general purpose or for a specific purpose, because ratios are there for general and specific purpose that you will learn in future. Ratios provide the relevant information which gives deeper insights into the actual situation of the firm than the absolute figures that fail to give analytical interpretations. Here you need to understand at the interpretation level, ratios are essential. Ratios play better role than absolute figures. Next one, ratio analysis provides information by making a comparative study of two or more items, which is more useful to make decisions. There one example is given here, like when you want to compare two companies or where you want to decide about your investment decisions. For all that, you can write any number of examples. Then it is better if you write two examples also, it's good. Next, another advantage, ratio analysis gives more information than the raw figures in the financial statements, because financial statements will have a huge number of items and figures with huge quantity of money. At once, we may not be able to understand the deeper level what the data means. So, that is what here, and an example, you please go through that example. Ratios summarize mass complex data into simple figures and prepare a comfortable base for interpretation that is easy to draw useful conclusions. This is another very important one. It gives the core of the complex data, or the core the message of the financial statements will be given by the ratios. You will get the cream, I can say. Then financial ratios can be computed and applied for various uses, such as understanding the current performance compared with the past, or to make projections into the future. This future projections is to plan, to make decisions, to estimate future trends, etc. Ratios are more convenient to deal for all these purposes than absolute figures in the financial statements. Financial ratios over a period of time help to understand changes in the concerned areas and also provides base to determine the developments, improvements, deterioration, or any going back, all such things in various areas of an organization. Thus, the ratio provides the total picture of a change, both favorable and unfavorable over a period of time, that shows the trends of change. So, we can understand whether it is a progressive trend or decreasing trend. So, that can be very easily understood using ratio analysis. Ratios are like benchmarks to analyze the performance of a particular firm, because they can be compared the performance with the predetermined or accepted standards. You know that benchmarking is usually used for the comparison. Benchmarking in this context refers to a measure that ratios, which is the standard ratios declared by the concerned authorities, can be compared. So, that can be so what is the company gives a standard, that standard can be accepted as a benchmark, and we can make comparison. This provides clarity over the present financial state of firm when compared to the standard ratios. The best example you can quote here is that RBI recommended banks to adopt capital adequacy of 8%, which is a benchmark for all banks in India to assess their capital base. One example. And another advantage is that there are different categories of ratios catering to the needs of different areas in the financial data of a company or for different kinds of business firms. This facilitates the study of multi-dimensional aspects of same area. See, for example, earning of a firm can be studied from profitability ratios, earning per investment ratios, earning per assets, earning per sales turnover, and so on. You can do it any number of ratios. This gives detailed and deeper knowledge to the management on the areas where they need to pay special attention to improve earnings of the firm. These are the few advantages we can say of the ratio analysis. That's all in this video.